For Jim Chalmers and Katie Gallagher, this is one of the biggest nights of their careers. The first economic blueprint of a first-term government will set the direction for the years to come. The nation's freshly redone books account for Labor's pre-election promises and highlight the need for budget repair.
There's a pretty big structural hole in the budget. Does there need to be a conversation about cutting spending or raising taxes?
Well, of course there needs to be a conversation about how we improve the budget position, but what we've done is we've made a really strong start here.
This financial year, the country is forecast to be $36.9 billion in the red. In the next, the deficit will rise to $44 billion, and by mid-2026, it's on track to be $49.6 billion. Things were expected to be much worse. The world's paying top dollar for our natural resources, and there are more people in work, which is helping boost tax intake. The Treasurer has decided to bank almost all that extra money, meaning compared with the March budget, net debt will be nearly $100 billion less in 4 years' time. But the cost of borrowing money is rising because of the increases in interest rates. By mid-2026, gross debt repayments will hit $31.9 billion, or more than the combined cost of higher education and the pharmaceutical benefits scheme. Interest rates are of course climbing to try to stem increases in the cost of living. Inflation, one of the big stories of this budget, is forecast to peak at 7.75% by Christmas and 5.75% over the financial year, before dropping to 3.5% the next. That's due to events like damaging floods, which will push up food prices, the Russian invasion of Ukraine, which is driving up energy costs, and COVID lockdown measures in China, our biggest trading partner. For wage earners, it's bad news because inflation will continue to outstrip pay packets this year, with only modest increases forecast from 2024. Electricity prices are a big contributor to inflation. They'll be 20% higher by December and a further 30% higher in the next financial year.
I think any responsible government facing these kinds of price hikes for electricity and for gas needs to consider a broader suite of regulatory interventions than they might have considered in years gone by.
This budget does include a so-called cost of living relief package worth $7.5 billion to deliver on already announced promises to make childcare cheaper, expand paid parental leave, cut the costs of medicines and build more affordable housing. But the Treasurer says he can't splash more cash without risking making inflation much worse.
The defining characteristic of this budget is spending restraint. And that's because the primary influence on the budget is our inflation challenge.
Also a challenge, economic growth, which is forecast to be 3.25% this year, falling to just 1.5% in the next. And more people are expected to lose their jobs in the period ahead, with unemployment increasing from 3.75% to a still low 4.5%. As promised, the budget makes space for Labor's big renewable energy plans, including the $20 billion fund to upgrade transmission lines. There are also some modest savings. Over the next 4 years, $22 billion has been cut or redirected from the former government's projects. An extra $3.7 billion is expected to be raised from tax compliance and $952 million from more scrutiny of multinational tax returns. But one of the government's biggest challenges remains the rising annual costs of the age pension, medical benefits, defence, aged care and hospitals, while the NDIS and interest repayments are expected to experience double-digit increases, putting big pressure on the bottom line over the next decade.
We're being upfront with the Australian people about some of the challenges that lie ahead.
The government's finance team say it's committed to putting the budget on a more sustainable path, but concede there's a lot of work ahead.